Joining us now is Charles Schwab, Chief Investment Strategist, Ann Sonders. Ann, great to have you back on.
Thanks for having me, Morgan.
It's interesting. The other thing we got today was Fed speak. Barkin, Bostic, and then I'll put Daly in, even though that was yesterday in a Wall Street Journal interview, into this bucket, too. We had seen some pushback on some of the dovish commentary coming out of the FOMC decision last week. And now, with this latest round of Fed officials, it would seem maybe some pushback on the pushback. What does this mean in terms of the rate cut picture for next year?
We don't know yet, and I don't think they do either. So we are, as I often joke, dealing with the Federal Open Mouth Committee, and there will often be cross currents in terms of individual members and what they opt to say at any moment in time. I don't think there's been this sort of collective decision to put out a more hawkish commentary after the dovish turn that Powell took, and in turn pushing back against that. I think each member is going to have their own view, but they are still data dependent. And I think the fact that the Fed via dots plot has 3 cuts priced in for next year, and the market has 5 or 6, something probably has to give. And we do think it may be premature to assume a cut as soon as March. But I think between now and then, you'll continue to probably hear contradictions, even from within the Fed.
You know, I was having a conversation with an investor yesterday, and I suspect, looking at your notes, that you'd probably concur with this, that it's not necessarily the number of rate cuts. It's the nature of the rate cuts. It's the size of the rate cuts and what's causing them that's going to matter the most.
Right. Yeah. So I think that ultimately the trigger for the Fed to actually pivot to rate cuts will probably be a function of their other mandate coming into clear focus alongside the inflation mandate. So the tightening part of the cycle was very much geared toward what was happening in inflation, and they weren't as focused on the employment side of their mandate. I think it's a combination of the two, and not just in the interest of easing policy because real rates go up if inflation continues to come down, but making sure that there's nothing happening on the labor market side that runs the risk that premature loosening would reignite inflation and let it back out of the bag. So I think we need to keep a close eye on the combination of inflation data and labor market data, and really focus on the dual mandate, not just the inflation side.
So, Ann, bringing it to the kitchen table, how do you filter for opportunity in this market? On one side, I see utilities, energy, consumer staples, healthcare have all been negative year to date, and I wonder, could they perform differently from here? But then I see the WCLD topped its 52-week highs from July 31st today, the cloud computing fund, but it's still way under the 50-plus where it was 2 years ago.
You know, in the case of energy, which is obviously in the leadership position today, I think short term it's going to very much be driven by oil prices. And you've seen oil move up from the low 70s to the high 70s more recently, in part due to, Houthi attacks in the Red Sea and the potential problems with the Suez. So you've got that as sort of a one-off sector that is driven by obvious, war and related issues and geopolitics. The other areas, I think, you get pops in areas like REITs and utilities with the move down in rates because it brings investors back into areas that they didn't need to look for income from when they could find it in money markets or treasuries. So I think that there are individual drivers. The one thing I'll say broadly that is probably most compelling is just the equal weight. I mean, the S&P equal weight index swung in only a 1-month period of time from a 52-week low to a 52-week high. And it's a very condensed period of time for that to have happened. And when you look at swings like that in the past, the subsequent 6-month performance looks quite good for equal weight. So I think that it's becoming more of a stock picker's market, and there are opportunities, outside just the Magnificent Seven. And I think there's a lot of money that is still itching to look for opportunities outside that very concentrated small number of stocks.